Welcome to the TheoTrade Weekend Update. This is Don Kaufman. It is September 18th, 2016. Let us start with a quick update of some of the action we saw last week, and we're going to move right into what is going to be a week apparently filled with some volatility, given the fact that there's an FOMC announcement coming out on Wednesday. But people, that's not really kind of the talk of the trading community. The trading community right now is focused on the Bank of Japan and ultimately their version of their meeting, which is going to be out on Monday evening, which I'll display in the volatility as we kind of move forward here. First and foremost, we're going to start with the S&P futures. And the S&P futures, of course, why do I start with them? Because they drive order flow to the marketplace. A couple of highly specific levels to look at inside of the S&Ps as we kind of progress, not only from last week, but really into this coming week. Obviously, we've seen a bit more volatility since that volatility kind of kicked off with a large down move on September 9th. We've actually been trapped inside of a relatively decent size range. Nevertheless, that range actually contracting as the week has progressed on. Now, the levels that you're looking at on the screen, and I just zoomed out there for just a moment so you can actually see where some of these levels are located. We'll zoom back in, are none other than 2153. Now, these levels have actually been adjusted given the fact that the futures contract rolled from the September into the December. This 2153 is the old 2160, which was an absolute key level, okay, moving back into what, July and August. So we've still got it on our screen, which happens to be an incredible important threshold to the upside. You know, the 2153 level, we breached it last Monday, albeit for a brief moment. Pretty much came in and touched into it again on Tuesday. Then we actually fell into this 2129, which is, again, kind of a key inflection point. Down below over here, we've bounced several times at 2112. And what we've actually seen for a recent bottom over here happens to be on, again, Monday, 2100, pretty much on the button. Now, to show you how much weight some of these levels hold, and again, I'm not a trader that uses anything along the lines of Fibonacci's, nothing like that. The levels that I'm presenting over here and have been presenting last week, their key points where hedging activity, okay, is persisting. Okay, so I'm actually going to show you, again, in a tighter time frame over here, and one of the ways to do that is to go to intraday trade, all right, and show you how much these levels have really meant. We'll go to a 5-day, for instance, 10-minute, and you can actually take a look kind of zoomed in. Yeah, you think levels don't matter over here? Hedging activity, all right, stops on a dime at 2100. We rip, literally touch into the 2153 for an albeit fleeting and brief moment. 2156 came right back down through, okay, to the 2112, bounced into this 2129, and the 2129 isn't necessarily a key level. It's more of an inflection point, okay, where we've actually been trading to. You can see us clearly crossing through it again and again. To keep these levels in mind, well, why? All right, one of the first things that you want to look at as we're going to progress into next week, we crest through 2112, okay? 2100 is going to be all but certain, and we'll probably cross through there. 2100, again, held here, all right? We rallied off of it. Nevertheless, this 2112 to the downside, okay, you have to expect that kind of action throughout the course of this next week, given the fact there's going to be all these announcements. To the upside over here, however, the 2153. Now, I'll show you this 2153 here, and you got to go back some serious time to actually kind of respect that particular level. But this happens to be 90 days of trade at 4-hour clips over here, and you can see for such a substantial period of time there is the 2153 level that was held. Again, very, very substantial kind of threshold. We get above it, the S&Ps, of course, can have room to run. So why am I looking at levels both to the upside and to the downside, right? Why not just have an outright directional bias over here? Because the answer is the Bank of Japan meeting, the FOMC, these are binary events to the marketplace. Now, I'm going to describe here in just a few moments how the market is anticipating a lot more volatility right now, and we can see that in a number of ways. But you still have to look at these kind of upcoming announcements here, and I'm going to go ahead and zoom back in on the chart, but these upcoming announcements as nothing more than what they are, and that is, again, binary events. When we say like a binary event, make no two ways about it. It's a coin flip away from exploding higher or lower. But we've actually been trading, again, really effectively on an intraday basis off of these levels, which, again, what are the levels based on? It's hedging activity. I'm not looking at, a MACD or a Fibonacci or, a Bollinger Band, nothing of the sort. It's where huge volume spikes are occurring, okay? For the most part, the way to think of this, okay, there's these degrees of risk that exist at different levels, okay? We ultimately trade down to that particular level. The degree of risk ultimately gets hedged off. The market can actually rebound. There's degrees of risk again. And you can see this as the futures have these giant volume spikes. Again, the markets aren't necessarily what you might think they are. They're not about just, let's go up or let's go down. Everything in the professional trading arena is about hedging activity. Most of the major derivatives firms on the planet, and derivatives firms, okay, that's a bank. It could be like Bank of America Merrill. It could be Goldman Sachs. All of these are trading firms. Most of them are not doing anything directionally biased in the market. In fact, again, a lot of regulations restrict them from doing things that are directionally biased. So what they use, okay, is predominantly market neutral type strategies. So when you're using a market neutral type strategy, as the market moves, you have to hedge with the dynamics of the market. And this is becoming more and more apparent, all right, in some of the recent trade as, again, these levels, all the firms have risk at those particular levels. And why is it so transparent is, again, every time we cross through a level, the volume kicks in over there, it's hedging activity. Now, this is not something that, the traders pre-plan, like, okay, let's everybody stop the market at, 2112. It's algos. And the algorithms know to which levels, okay, that they personally have risk, meaning that that algorithm is looking at the firm's risk, and that algorithm is actually buying and selling futures based on what the firm's risk is at any given levels. And you hit these key inflection points, right, where, again, markets have tendency to kind of turn around. So just explaining, in a little bit detailed over there, you can't think about this as an algorithm that's like, it's going to buy the market forever. Well, quite the opposite. All right. This can actually create substantially more volatility when you start to recognize what do these algorithms do, all right, when the market starts to buy. Well, they buy with the market. And if the market starts to sell off, they're going to sell harder into that market. And that's why we can get some, really high levels of, volatility in a very short span of time. Now, let's actually clear this and start looking at some individual products out there. Then we'll come back around and look at volatility on the week. One thing that actually stands out to me, XLF, and not only does it stand out to me, it's a little bit perplexing. And I don't mind telling you when, you look at a marketplace and you're like, well, it is what it is. First of all, the XLF, okay, it's got to be, again, in your mind throughout the course of this week. Why? Number one, it's not per se tracking with the S&P 500. Take a quick glance over here at the spiders. All right, so there's the spiders. Spiders obviously broke down, but have actually stabilized right here at this about, 213 level. So the spiders, the S&Ps stabilized the 213 level. You take a look at the XLF, a very different picture. It's just breaking down. And the XLF, okay, is kind of dangling right at the edge of a cliff over here, this 2350. Now, I'm not necessarily throwing like that key level out over there, but nevertheless, you can see in some of the recent trade, you crack through 2350 and, it's a long way down. But what's perplexing about this trade is that if you looked at interest rates, okay, TNX, let's go over to TNX. What's TNX? It's 10-year Treasury Index. But if you look at interest rates, they went up. aren't the financials supposed to perform better when interest rates are going up? Okay. Is this lack of trust, or is it a sell-side opportunity before they come in and start whacking the financials before the FOMC and before the Bank of Japan? Again, Bank of Japan is where it's at this week. All right. The Bank of Japan is the petri dish for the central bankers around the world right now. Are they going deeper into negative rates? Okay. Well, once you get out and start, digging, you might as well just go for it at this point. They've painted themselves into a spectacular corner. Nevertheless, the brunt of that feels like, again, it's playing out inside of the financials. Now, the financials, this is important, seeing a lot of volatility this coming week. Why? It should be. Okay. The volatility is going to be elevated inside of your financial products. And again, if you look at the 5-day options, inside of the XLF, what do you got? You got 5 days, but you got about almost 27% volatility. Okay. Now, the reason I throw the 27% volatility up there, everybody's talking about Apple right now. Okay. Apple has 27% volatility. So to compare, all right, and I know people fixate on individual stocks, and I'm telling you, right now, in this market, it's not the time to be myopic. I don't care. You're going to make money. You're going to lose money in Apple. Apple's order flow, all right, throughout the course of this week is going to be dictated heavily by what's going on in the broader markets. All right, there's nowhere you're going to be able to hide out there. But the reason I bring up Apple is because Apple is just on fire, right? Stock explodes to the upside. Everybody's focusing. It's got 27% vol. Yeah, ironically, the entire sector of the financials, their vol is sitting right at about the same level. Strange? Yeah, I think so. Strange? I mean, how awkward is this? We have an entire sector that has, the same volatility as one individual stock. It almost doesn't make sense in the marketplace. Anyway, in the XLF, if we bounce, I'm looking to sell into it. In the XLF, if it bounces to the upside, I'm going to sell into it. And it is very likely that earlier in the week, we do see a bounce to the upside. I mean, this thing can't catch a bid for nothing. Okay, that means it can't go up in the last couple of days. So I'm actually going to look to sell into strength in the XLF. And again, early in the week over here, some feelings, right? Maybe we do bounce in it. Now, I'm going to come back over, and I am going to take a look at the bonds, because the bonds, they're also, moving markets out there. So one thing you want to do is anytime you look at a bond or a bond future, you have to come over here, hit the little sprocket, go to futures, make sure you adjust for contract changes, apply, okay, makes it a continuous contract. So the bonds also appear to be sitting at a very key kind of threshold level. Let's just call it 165. Again, you look across the chart, you look back through time over there. It was the low here, it was the high there. Sure, good enough for me for support and resistance. Couldn't the bonds break down? This is the marketplace, all right, that you got to keep your eyes on. Again, the bonds have been selling off, and yet the financials are selling off with them. Okay, to me, that's the beginning of the end of, first of all, complacency in the market. And complacency in the market, all of a sudden, again, you're getting the bonds selling off, with financials selling off. Again, curious, unusual, absolutely, but the bonds this week, they cracked solidly below 165, and it's going to be all over, meaning the interest rates could really start to take off to the upside. Now, do I really expect that to happen? Not necessarily so. I actually think that the markets this week could get a little jittery later in the week, and what I want to see is if the S&Ps start to get tagged. That is, if the S&Ps start to sell off late in the week, which is kind of what I expect. I want to see if the bonds actually get bid up. We haven't seen that lately. We've seen the S&Ps selling off with the bonds selling off. I want to see some real selling in the S&Ps to see if capital starts flowing back into the bond market. Again, we've been in a highly unusual marketplace where the S&Ps have rallied with the bonds rallying. Those things, historically speaking, were supposed to move what? Inversely proportional to one another, right? So what do? You get the bonds down one day, you get the S&Ps up, you get the S&Ps down, you get the bonds up. Well, it's not working that way right now. Nevertheless, pretty sure if the S&Ps late in the week start to really what I call feel the fear, If you don't know what that means, you've never traded in volatility. But if the S&P start to feel the fear out there, let's see if the bonds start to get rocking back to the upside. So a little bit of normalcy. Now, if you're looking at gold, you're looking at oil, okay? I'm taking those off the table. All right, meaning I'm not necessarily going to be trading in gold and oil, and I do trade these products, but if you take a look at the trade recently in oil, okay, it's being influenced a tremendous amount by the dollar. So this, I mean, to me right now, any of the commodity products, it's a dollar bet, whichever way you want to look at it. Look, strength in the dollar, what do we get? And that was some pretty good strength in the dollar. Weakness in oil. What do we get inside of gold? Because everybody's looking at gold. Weakness inside of gold. So there's an inverted correlation there, right? Dollar strength, weakness oil, weakness gold. Where is the dollar likely to be headed this week? Well, for that, I wouldn't even necessarily look at the FOMC. I would actually look over at the Japanese yen. Okay, here I see a big opportunity. And I'll probably update you guys on this opportunity kind of later on during the week. But I am looking, okay, to get short yen. Not now, after the Bank of Japan meeting, after the FOMC meeting. Later in the week, I'm actually going to look to get short yen. It's not often I talk about currencies over here, but I think that this is going to be a stellar trade. However, in the short term, I want to make this absolutely clear. I actually think after these meetings, this little monkey's about to explode to the upside. Okay, I think we're going to get one big hurrah to the upside. Talk about consolidation and danger right now. I wouldn't be long or short the yen for nothing until it makes that broader move. Now, if the yen just breaks to the downside, hey, so be it. I guess I missed the trade. But the opportunity here, okay, once again, is to sell into strength in the yen. I'm looking for that in the XLF. I'm looking for in the yen moving forward in this week. Last but not least, let's cruise over to Google. Okay, I put a short position on Google earlier in the week. That is, I used an in-out spread on Google, which has been hugging pretty much this 800 level like grim death. For the most part, NASDAQ is just off all-time highs. Google is just off all-time highs. Again, sold into some strength kind of late in the week here on Google. Decent position. We'll see how it actually plays out over time. Again, I have tendency to use in-out spreads. If you do use one, you have to use the 26-day expiration. Why? Because there's going to be an earnings out there on the horizon. And, I don't want to get too close to the earnings announcement. I got 26 days for Google, for the most part, to be under about $7.95. Pretty comfortable with that one. And again, to kind of wrap things up here on this weekend update, one thing I want you to keep your eyes on throughout the course of the week, the expected moves inside of the SPX. Okay, can't go without mentioning these. You've got 1 day, 3 day, 5 day. You got to love this. There's a Monday, a Wednesday, a Friday. And the volatility, they're picked up over here for sure. But one thing really seems notable to me, there's only a $35, $36 expectation of price action throughout the entire course of the week in the SPX. Once again, from where I stand, I don't really want to sell into that. Why? It's a $35, $36, we'll call it a $36 expected move. Now, have you not seen some of the action of the previous week? That's a $56 move. Okay, this is almost a 40-point move. Sure, the range as the week went on, all right, if you're like technically oriented, consolidated. What are we forming? A giant wedgie! It's a pennant. It's a wedgie. What does that mean? Well, we can go up, we can go down. Nevertheless, okay, we've actually had a big consolidation pattern here in the SPX. Again, I don't know about you, but I'm not comfortable selling premium in a week, all right, where in the previous week, almost every move was larger than like $25 a day. This whole week is only going to pay me $36 though to sell premium. Again, the premiums seem inordinately low given some of the risk we're seeing out there. Again, stay tuned. I'll update you guys a little bit more come Monday towards the close over here. Don't forget, again, this is a week filled with announcements. S&P futures could be rocking on Monday night after the Bank of Japan actually comes out. Expect some volatility being thrown off this week. Keep your helmet on because the volatility, it is still It's up there, right? And traders, they're buying volatility right now. You can see that through the means of looking at the VVIX, the volatility of the volatility index. Got to keep that in the back of your mind throughout the course of this week. Have a good trading week. Again, update you guys after the close on Monday. Bye-bye.